Typically, if you're willing to take more risk, you can also expect to earn higher returns when investing in REITs. To illustrate this point, we can look at the past returns of two net lease REITs, Essential Properties Realty Trust and Realty Income. Both of these REITs invest in net lease properties, but because Essential Properties Realty Trust has been focusing more on riskier and higher yielding properties, it has historically been able to earn higher total returns, but these returns have also been somewhat more volatile. This is why at High Yield Landlord we have two portfolios. We have the core portfolio, which aims at maximizing total returns, and so this one will favor REITs such as Essential Properties Realty Trust. And then we have the retirement portfolio, which aims at maximizing safe income, and so this one will favor REITs like Realty Income. But then on some really rare occasions, some high quality REITs become so cheap that they could make sense for both strategies. There aren't many such opportunities in today's market, and in today's video I want to highlight two of them to you. Hey everyone, this is Yossi. I run a small investment firm that specializes in REIT investing, and in today's video I want to talk to you about two REITs that I think could make sense for most REIT portfolios. But before I get into it, could you please do me a favor and like this video? It will really help me a lot to grow this channel. I'm currently actually in Lapland on holidays, but I still decided to film this quick video for you. So again, if you could like the video, it will really help me a lot. Thank you very much. So the first REIT that I think most investors should own in today's market is called Alexandria Real Estate, ticker symbol ARE. This is a REIT that I've previously covered on this channel because it's currently one of my largest holdings, but today I'm going to present it to you from a different angle. So Alexandria Real Estate is really what you would typically consider as a blue chip company. That's because it owns Class A life science buildings that enjoy high occupancy rates and strong rent growth. Then secondly, it has a very strong investment grade rated balance sheet with a BBB+ credit rating, long debt maturities and low debt. And then third, it also has a really strong management team that has a track record that's among the best in the entire REIT sector, outperforming even companies like Berkshire Hathaway, which is managed by Warren Buffett. But despite that, over the past year, it has seen its share price crash. It's been about cut in half, and as a result, its valuation is today historically low, trading at just about 13 times FFO and an estimated 40% discount to its net asset value. Why is it so cheap? I think that it's because of three key reasons. The first reason is that it's often associated with the office REIT peer group. Today, Alexandria is the only REIT that invests exclusively in life science buildings, and as a result, it doesn't really have a peer group. It has no direct peers, and so because of this, NAREIT, which is the representative body of the REIT sector, has historically grouped Alexandria with other office REITs. As a result, it seems that a lot of market participants consider Alexandria to be an office REIT, but in reality, the fundamentals of life science buildings and those of office buildings are day and night. The work that's done inside life science buildings cannot be done easily at home, and today the demand for life science buildings is especially strong in the post-COVID world as a lot of money is pumped into research. As a result, Alexandria's occupancy rates are really high, about 95%, and at the same time its rents are growing at a rapid pace. Despite that, Alexandria has shown very high correlation with other office REITs, and I think that this is really unwarranted. Then the second reason why Alexandria has sold off so much is because the market seems to worry about the VC funding of some of its tenants. Some of Alexandria's tenants are small biotech companies, and today they're having a much harder time to raise new capital because interest rates are so high. However, what the market here appears to have overlooked is that these same tenants had their best VC funding year ever in 2022, and it will take them many years to allocate all of this capital. Just recently, I got to meet the management of Alexandria at the City Global Property Conference, and they seem very confident about the health of even their smaller tenants. So once more, I think that the concerns here are overblown. And then the third and final reason, which is really impacting the entire REIT sector, is the recent surge in interest rates. The market worries that this is going to lead to an increase in its interest expense and so a decline in its cash flow. But a great thing about Alexandria is that it has one of the strongest balance sheets in the entire REIT sector, with a very low LTV of around 25% and exceptionally long debt maturities of about 13 years. Therefore, the impact of rising interest rates really isn't significant significant here, and at the same time its rents keep on growing rapidly, and this is what has allowed the REIT to guide for 6% AFFO per share growth in 2023. So to recap here, I think that there are three reasons why the market is pricing Alexandria today at such a low valuation. Many investors see it as an office REIT, then some investors are concerned about VC funding, and finally the market is overreacting to rising interest rates. I think that this is a great opportunity for long-term oriented investors because most of these factors are really impacting its market sentiment today, but if you look at the fundamentals of the REIT, they remain particularly strong. Historically, this is a REIT that has been pretty expensive during most times, trading at over 20 times FFO because of all the qualities that we highlighted earlier, but today you get to buy it at just around 13 times FFO, which is a historically low multiple. Just between the 4% dividend yield and the 6 to 7% FFO per share growth, you can expect to earn double-digit total returns, but then on top of that, as it eventually reprices at closer to 20 times FFO, you can also expect over 50% upside potential from here. That's very compelling coming from a relatively safe REIT, and this is why I think that Alexandria could make sense for most REIT portfolios. Then the second REIT that I think would make sense for most investors is called Crown Castle. Its ticker symbol is CCI. If Alexandria is the cheapest blue chip in the REIT market today, then Crown Castle will be the highest yielding blue chip in the REIT market. Today it's offered at a 6% dividend yield, which is the highest yield ever for this company. Historically it's been priced at closer to a 3% dividend yield, so 2 times lower level. The reason why the yield is so high today is because its share price has crashed even as the REIT kept hiking its dividend. And just like Alexandria, I think that the market has here really overreacted and this crash shouldn't have happened in the first place. The reason why the market is pricing Crown Castle now at such a lower valuation and higher yield is because its next 2 to 3 years are going to be a period of slower growth. Crown Castle is a cell tower REIT. It was recently negatively impacted by T-Mobile's acquisition of Sprint. It's going to lead to some lease cancellations over the next 2 years, and it's going to negatively impact its growth. But this is not the end of the world. The REIT has made it very clear to the market that past 2025, the growth is going to return to its historic range of 7 to 8%. It has reaffirmed this in the first quarter and once again in the second quarter earnings calls. I think that real estate should be valued based on decades of future expected cash flow, and therefore the impact of 2 to 3 years of slower growth really shouldn't be that significant. And so I really like this opportunity because now you get to buy Crown Castle at a historically low valuation, a historically high dividend yield, and we have a clear path to returning to a higher valuation eventually as its growth reaccelerates in 2026. And once again, this is a REIT with all the characteristics that we would expect from a blue chip. It has Class A properties with steady growth prospects, it has a strong investment grade rated balance sheet, it has a management team with an exceptional track record. Historically, they've actually grown their dividend at closer to 8 to 9%. Now they are telling us that the growth is returning to 7 to 8% past 2026. And given their track record and the growth that's happening in this sector, I think that we can take their word for it. Alright, I'm just pausing this for a second to show you something. Look at this, what I have by my window. There's reindeer, a lot of them here in Lapland. Today the shares are priced at a 6% dividend yield, but as they return to this faster growth, I expect the shares to reprice closer to a 4% dividend yield, which is still higher than where it traded about 2 years ago, but just that would unlock 50% upside for shareholders. And so again, I really like this opportunity because you get to earn a high yield, high upside potential, you have strong growth prospects, and this is coming from a relatively safe REIT that has recession-resistant fundamentals and a strong balance sheet in today's rising interest rate environment. Now, if you want to learn more about what other REITs I'm buying in today's market, feel free to join my REIT newsletter for a 2-week free trial. I'll put a link somewhere in the description of this video. It will give you instant access to my entire real money REIT portfolio. And otherwise, once more, if you could like this video, that will really help me a lot to grow this channel. Thank you very much and see you at my next one. Bye-bye.